Is Scuttlebutt. So Scuttlebutt is basically knowing the products of the company before investing into it. So let's say I am investing into an ice cream company and I haven't tasted the ice cream of the company, which the company is manufacturing. So that doesn't make sense, right? So I'm investing in an ice cream company, and if I don't know how the ice cream tastes, what if it is not good for the market? What if ice cream doesn't taste good? So like, then it doesn't make sense to invest in a company. So importance of Scuttlebutt is very much. So we should start with meeting the customers. So let's say the company is Sera, right? So Sera is manufacturer of vitrified tiles. So meeting the customers. So what do customers feel about the product of the company? After meeting the customers, taking their reviews, knowing their points, we should meet. I meet the suppliers and distributors of the company. So suppliers and distributors are the ones who know the actual demand of the company, what's happening in the company, how is the distribution set up, how are they planning to grow, because distributors are the one who takes them to the retail customers, right? So after meeting the suppliers, distributors, knowing their issues, knowing good things about the company, I visit the plant of the company. So visiting the plant, you also meet the employees. So this is like one of the major factors which I think, meeting the employees of the company. So employees are the one who actually knows what's happening inside the company, because they are the ones who are taking the company to the next level. They are the ones who are manufacturing the product for the company. So let's take an example. So recently I visited a company and I met the factory manager of the company. So factory manager was the one who told me what was going on in the company, how is the export demand. So as we know that Q2 was great for some companies, right? So I met the management. I visited the company before the Q2 results. So while meeting the company, while meeting the employees, the factory manager told me that they are having huge demands from the export side, right? So I could analyze that something good is going on right now. They are having huge demands from export. Might be due to lockdown, the pent up demand, but yeah, they would have good Q2. I predicted, yeah. And after meeting the employees, finally meeting the management. So meeting the management is as important as meeting the employees, because management is the one who is going to run the company at the end. So let's say we've invested into a sunrise sector, but what if the management is not motivated? What if management doesn't want to grow? So like our investment won't grow if the management doesn't want to grow the business. So it is very important to meet the management, know the management, know the vision of the management. So at the end, I would say that the vision of the investor and vision of the management should meet. So if we have some vision for the company, like let's say I've invested in a company, I think that company would grow 10x, 20x because the sector is performing very well. It is a sunrise sector. But what if the management of that company doesn't want to grow? What if the management of the company is satisfied with the current business? So what if the management doesn't want to take the company to 10x? So then it doesn't justify my investment thesis, right? So it is very important to meet the management and know actually what's happening in the company and where the company is headed. So yes, scuttlebutt is very important, and these are the 5 factors which you need to take care of while investing. The other point is wealth creation. So our focus while investing should be wealth creation and not just to make like 5, 10, 20% of profits, right? Because we are investing our wealth, we are investing our savings. So it should be for a big purpose. It should be to create big money. And wealth creation is only possible if we have a good earning visibility of a company. If we know that company has a huge size of opportunity. Let's take an example, like a company having revenues of 500 crores and the market size of that industry itself is 1,000 crores. So company can't grow more than 1,000 crores because the market size of the industry is 1,000 crores. So it's only some growth potential left for the company. And if company can't grow, then of course our investment won't grow. So it is necessary to know that the businesses which we invest into have huge size of opportunity. So the first example which I have taken over here, like anyone take a wild guess and guess the company which it is. It's a MNC, just to give a hint. And this is a product which every one of us have used like once in our lifetime at least. Anyone write in the chat box and Yesh bhai can help me in knowing your answer.
Sure. So, any guesses?
Any guesses,
Nestle,
guys?
HUL?
So this is a MNC company. We have used this product in day-to-day lives. We use it every day.
Okay, I think now Keval has made it very easy. Now we can get the Unilever. So we are getting some on people on Facebook also. Colgate, HUL, Colgate.
Yeah. So it's Colgate actually. So Colgate. So the story behind Colgate is we are not going to brush our teeth twice a day or thrice a day, right? So Colgate is penetrated in India, and like people are not going to brush their teeth like 3 times or 4 times a day. So it can't grow much more, right? Because everyone is using Colgate or any toothpaste, right? So the thing is, it should have a huge size of opportunity. Let Colgate be a great company, great management, MNC having great return ratios, ROC of 50% plus, great cash flows. But when the company can't grow, our investment won't grow. And we have the example over here. So the sales of Colgate has compounded at 9% over last 10 years. In 5 years, it has compounded at 3% CAGR. In 3 years, at 4% CAGR, right? The profit has compounded at 7% CAGR over last 10 years, 5% at 8% over last 5 years, and 12% at last 3 years. And it is reflecting in the stock price very evidently. Like if the company won't grow, stock price won't grow. So stock price is merely compounded at 13% CAGR at last 10 years, though it's not bad for like investors who do not want to risk their investment much. It's fine, but yeah, over the last 5 years, the company has only compounded at 10% CAGR. Whereas the next company which I've taken is a specialty chemical company. So as we know, specialty chemical is a sunrise sector, huge size of opportunity, China substitution. So this company which I've mentioned has grown at 17% CAGR over last 10 years and 26% CAGR over last 3 years. So this is huge. So a company growing at 26% CAGR over last 3 years is huge, and which of course will be reflected in stock price, and which we can see over here. The company is compounding at 55% CAGR over last 10 years. So that is huge. So that would be vast for wealth creation.
I think your screen, the slide is not changed.
Is the slide changed?
It's still showing the wealth creation.
Yeah.
Now it's changed.
Yeah, so I'll just explain through the figures over here, which I mentioned over here. I'll just explain the stock price growth can you see the stock price CAGR?
Yeah, now we can know it's again the wealth creation page which has come up.
Yeah, I'll explain the stock price CAGR in the wealth creation page, and then I'll move forward.
Sure. Yeah, we can see that.
Yeah. So as I said, that the sales should grow. The company should have a huge size of opportunity for growth, right? So over here we can see that company has grown at 26% CAGR over last 3 years, and this is reflected in the stock price. The stock price has grown by 80% CAGR over last 3 years. So it's not 80% growth over 3 years; it's 80% CAGR. So 80% in first year, 80% above that, and 80% above that. So that's compounding at 80% over 3 years. So that's huge for investment. So how can we get sunrise sectors? So how can we know what are the tailwinds? So the first is that company has huge size of opportunity to grow. Second is that promoters aggressively increasing the stake. So this is a good sign. So if promoters are aggressively increasing the stake in the business, so that means that something is brewing in the business, that something interesting is happening, that promoters are increasing the stake. So this is not the only point on which I take investment decisions, or we should take investment decisions, but this is one of the factors where we should look into the company for investing. The third point is smart money inflow. So smart money inflow is money of institutions. So where institutions are investing in the companies at a very early stage. So institutions have insider, like institutions know the management, meet the management, they have information like what's going on in the company. So if institutions are invested at very early levels, then that is a good sign to look into the company. And last point is capex. So company will only invest in their capacity, only will increase their capacity if they are seeing a huge demand coming up in the market. So if company is doing a capex, then that's a huge positive sign. The last point is odds should be in our favor. So catching the companies early in the cycle, it is very important. So to invest a sizable amount in the company, get a sizable stake, and the downside risk being low compared to the upside potential, we need to catch them early. We need to invest at good fair valuations. If we invest at fair valuations, then only we'll able to invest good amount and take a sizable stake in the company. Otherwise, we won't be able to get a sizable stake in the company. And the third point is make the most of the corrections and buy on dips. So as I mentioned that if we know the management, if we know that where the company is heading, so when there are corrections, let's say the company fell by 20%, then it would be welcoming for us. We would invest more when company is corrected 20%. Instead of hesitating, and we might also exit our investment if we don't know the company, if we don't know where promoters are heading, if we don't understand the business. So it is very important to buy on dips, buy on corrections if we know the company and if odds are in our favor.